The quirks and eccentricities of human beings lead us to make mistakes when investing in the stock market, and this can cost us big in lost returns. Here we go through 4 investing mistakes and how to avoid them. And at the end, we've got a little bonus mistake that we think is very topical right now.
Hi, I'm Marcus De Silva.
And I'm Simon Longfellow.
Welcome to the Steps to Investing channel, where we help everyday folk learn some really simple investing skills to help them achieve financial freedom. Now, if you're new here, make sure you subscribe to the channel using the button below and turn on notifications. We release videos every Monday. And if you have any questions on what you're about to watch, then just comment below and we'll reply. We love to help.
Now, we are all emotional and irrational creatures. It's the beauty of what makes us human. It's important to remember that when investing in stock markets, all the traders and investors out there buying and selling shares and other types of financial instruments are just as human as you. In the high octane pressure of making and losing money, fears, anxieties, past experiences, they all mash together to create irrational instincts that can actually be at the helm of our decision making. It causes us to make mistakes and push buy or sell when we really shouldn't. And these instincts need controlling. Now, we know firms that teach trading, and controlling human behavior is a core part of what they teach. In fact, it's what cuts a good trader from a bad one. Now, we're not here to teach the complexities of trading, but rather just some simple mental attitudes you can apply when investing as an amateur in funds or in shares. If you apply them, it will save you so much money over the years. I can just guarantee that. Want to find out more? Well, one thing, please like the video and leave any comments below.
Mistake number 1, using the past to find a price. So what this is looking at past prices to give you an idea of what you think something is worth today. It's known technically as price anchoring, and it's more common in life than you would think. Good example is we've all been in supermarkets, right? And they use former prices and discounting to compel us to buy stuff. We've seen Jaffa Cakes loudly proclaiming at the end of the aisle that they're 50% off. And you swear you've never bought them at £2 a pack, but here they are, 50% off, and now £1 a pack. Now, lots of us know that supermarkets are just inflating prices for a while so that they can then drop them down and claim they are reduced to create this feeling of a bargain. But boy, does it work. I have a cupboard full of Jaffa Cakes. What you're doing is using that original price as a benchmark to anchor how much you think something is worth. Even though you know it's probably not the case, it's still quite compelling, right? In investing, this has 2 effects. You see a chart, a price chart that has been falling for years, and you think to yourself, what a bargain. Or you see a chart that's been going up for years and think to yourself, now this is a rip-off. And it leads to silly purchases or sales. Now, it could be a bargain or a rip-off, that's perfectly fine, but there could be good reasons other than that for why the charts are doing what they're doing. Within an individual share, you need to remember that a share price is not just plucked from thin air. It's based on what investors think a company is worth, according to how profitable the business is now and in the future. If a share price has plummeted, it could be because investors are less sure about the prospects for that business's future. Rather than it being a bargain and something that will recover, that downward spiral could continue. If the price has been rising, it could be because the company is simply creating popular and profitable products or services. And again, that share price could continue to climb as the team continue to roll out awesome stuff. Now, in the funds world, with a diversified fund, a downward trajectory could be because maybe the fund manager has lost their edge, having a midlife crisis, spending lots of money on leather jackets or Ferraris or hair implants, and is no longer picking winners in the fund. If the fund is increasing value for long periods of time, it could simply be because they're a superstar fund manager who understands their market well and they know how to pick good investments. So my point is, either way, this is why the regulator of financial markets says past performance is not a guide to the future. You need to consider what will drive the performance of investments into the future and not use prices as an anchor. Now, for picking shares, analysing shares, it's quite tricky, and I'm not going to go into that. But when selecting funds, which we would say are the best investments for building long-term wealth, you need to look at things like the investment strategy or the tenure of the manager, the costs, and so forth. There are a few different things. If you stick around to the end, we'll share a link on a video on just exactly how to do this.
Okay, mistake number 2. The losers tempt us to keep them. Now, it's a simple fact of human behaviour that we hate losing more than we like winning. I'm sure this is a feeling the English football team has become all too familiar with. Sorry, too soon. It means, though, that we get emotionally attached to investments that are losing when actually we should be far more rational. It's known in the jargon as the disposition effect, and it means when we're looking at our investments online, we see ones that are in the red, the ones that have gone down, and think, well, I'll just wait. I'll wait until it's gone green and then I'll sell. In addition, we see others that may be in the green that have gone up and get concerned about them going down into the red. And we think, I better sell these quickly. This clips our winners and holds on to our losses and is probably one of the biggest impacts on your returns. Don't do it. Whether it's shares or funds, if they go down, find out why. If something big has happened that changes the reasons you invest in the first place, don't be emotional. Get rid, move on. Now, there's plenty of opportunities out there, and every investor has investments that don't work. It doesn't make you an idiot. If they're going up, remember, if you're nervous, you don't need to sell out completely. You can sell a small portion. It's known as trimming, and what it does is lock in your gains on the way up, which will make you feel a whole lot better. It's known as running your winners.
Mistake number 3, overconfidence drives us down risky side streets. Success breeds confidence. Especially in investing, you start to believe you are a genius and tomorrow's Warren Buffett. Don't be fooled by this. Most of the time, gains are caused by big, broad market moves that form a tide that raises all the boats. Plus, you might get some additional bang from a good fund manager if you're using a fund. The problem is when you start to believe your own hype, you begin investing in riskier and riskier stuff that you may not fully understand. So this could be plowing large slices of your entire money, your entire portfolio into riskier stuff like crypto or gold or individual shares. Also, we tend to have multiple investments in our portfolio. And what this behavior does is it starts to skew the percentages of each of these investments and misbalance the risks you are taking. So rather than having a small slug in something really risky like crypto, which you might have like 5 or 10% of your total money, you start thinking to yourself, okay, I know what I'm doing. I'm going to put 40% in this single coin. Don't believe your own hype. Make sure you do your research on each and every investment, and also make sure you are nice and diversified across lots of investments in sensible proportions, and don't lose sight of that. The trimming of winners that Simon was talking about stops investments from climbing to higher percentages of our entire portfolio, and it enables us to recycle some of those gains into other investments, therefore reducing the risks whilst giving you the time to seek out new opportunities.
Okay, final main mistake number 4, that personal beliefs aren't a good way to invest. We are a biased lot. We tend to seek out facts that confirm our beliefs rather than form beliefs based on the facts. It's called confirmation bias. Here's an example. We all love Teslas. Now, aside from how nauseating Elon Musk might be, they are pretty cool looking cars that don't spew out horrible gases into the atmosphere. But does this make them a good investment? Well, maybe, but if a mate who, say, dabbles in investing tells me they're a good investment too, I'll be the first to admit I'd be quite tempted to buy the stock, even though I haven't done the work to look into the market or the company and its finances. This is how this trait manifests itself in investing. We tend to go ahead with something once our bias is confirmed, like acting on tips from friends or family, rather than researching widely for a balanced view. Newspapers, magazines, ourselves at Steps to Investing, data providers, investment platforms, whatever it is, use a variety of stuff that's independent from product providers and gives you this overall balanced view.
Okay, we said we'd add in one more. So for the bonus mistake to avoid, FOMO, fear of missing out. Getting caught in a fad is the #1 way to lose money in the stock markets. Just ask anyone who was conscious of the dot-com crash. This is because share prices become really irrational when certain investments or technologies or things like that get hyped and overblown. Now remember how I was saying that share prices are based on a company's profitability, right? Usually with a fad, the share prices become totally detached from this reality. It creates what is known as a bubble, and we know the fate of bubbles pop. The problem is, it relies on another person who's a greater fool to buy those shares that you've bought, someone with even less knowledge or experience, or even jumping on the hype even more than you are, rather than a rational investor. Fads are recipes for eye-watering losses. Avoid them.
Okay, that's it. We hope you enjoyed the video. Please subscribe or leave comments if you did. And just as an extra thing, we have a magazine out now stacked full of investment ideas for those wanting an income from their investment. So a passive income. It's free. Give it a whirl and let us know what you think. The link is in the description below. Thanks for watching. See you again next time. Goodbye.
Bye.